Obviously, this webinar is titled Credit Unions, Crypto, and Custodians, a Regulatory Review. It's being presented by CU Digital One. I am Josh Herman, the CEO of CU Digital One, and I'll be the moderator today. Just a quick history about who CU Digital One is. We are a credit union service organization owned by credit unions, or otherwise known as a CUSO. We are a holding company focused on three forward-looking verticals: digital assets and blockchain, digital investment solutions, and artificial intelligence. And as the title suggests, today's webinar is focused on digital assets and blockchain, and more specifically, the current state of digital asset regulation, focusing on buy, sell, hold of cryptocurrencies through credit unions. The importance of well-regulated institutions offering secure and safe cryptocurrency investing solutions for their members is absolutely critical. As such, this discussion will also cover NCUA guidance, the value of credit unions offering digital asset solutions, where the industry is headed, and the risks and opportunities that crypto presents to credit unions. This webinar is being recorded and will be available after the session. And on the panel today, we have Kyle Hauptman, the Vice Chairman at NCUA, Larry Pruss, Managing Director at SRM, and Kian Sarreshteh, CEO of CryptoFi. And then again, I will be moderating and attempting to keep us moving along. However, if you go off on a tangent here, that's absolutely totally fine. We do have prepared questions that we will discuss, but please, if you have any questions you want answered live here, there is a Q&A function, so please feel free to submit questions, and we'll do our best to get to many as possible. Panelists, I'll go through each question here and call on someone to address each one, but obviously, as we've already been doing, anyone, please feel free to jump in. I think we have some really good experts on the call here, and we can have some really good dialogue and conversation. But before we jump into the first questions here, let's go around the screen here and do some introductions. And Kian, if you can go ahead and start, and then Vice Chairman will go to you, then Larry, if you want to wrap it up on the intros.
Sure. Yeah, I'll try and be brief. Kian, co-founder, CEO at CryptoFi. We serve credit unions with a buy, sell, hold solution where you have a technology layer that sits in between the credit union and the members and the qualified custodians, which is the topic that we were diving into before this officially started. So yeah, excited to be here.
This is Kyle Hauptman, Vice Chairman of National Credit Union Administration. I'm one of the 3 board members at NCUA. If you're not that familiar with NCUA, I am indisputably a fan of the potential of digital assets and blockchain technology, but more to the point, a fan of letting Americans do what they do best, which is innovate and grow the economy.
And I'm Larry Pruss, Managing Director of Digital Assets and Emerging Technologies. At SRM, we negotiate third-party vendor relationships, do payment strategies, and keep on top of all emerging tech, basically advising banks and credit unions.
Perfect. Welcome, panelists, and welcome everybody who's tuning in here. So first question, Kian, I'll go to you on this one. Just to level the playing field, when we talk about a custodian, what are we actually talking about?
We're talking about the entity that's actually holding the crypto. And in the case of credit unions are not advised to custody their own digital assets, at least in our point of view. And using a third-party qualified custodian will ensure that third party holds the crypto on its balance sheet, so it's not hitting the credit union's balance sheet. There is an interesting subtopic to dive into, which I'm sure we'll get to today, around SAB 121 that speaks to that. But by leveraging a third-party custodian, the credit union members' assets, digital assets, are being safeguarded and held safe by a regulated entity. So in thinking about custodians, the key word is qualified. Qualified meaning it's regulated. So the 2 credit unions that we're live with right now, We Street Credit Union in Tulsa, and then Frankenmuth Credit Union in Frankenmuth, Michigan, are both leveraging Etana custody. It's ETANA. They are a Colorado trust company, but we also partner with other custodians such as BACT, who's regulated by the NYDFS, SFOX, and several others. So I think that addresses your question.
Perfect. And this next one, Vice Chairman, I'll start with you, but we can go around the horn with this one. But so what is your view on credit unions actually offering digital assets to their members and utilizing a third-party provider to facilitate this buy, sell, hold transaction?
Yeah, all third parties. Okay, one reason that we don't have a whitelist, even though some people want us to, of good partners, bad partners. I meet people and they want to tell you about their cool fintech, and I say, listen, I'll learn because I want to be smart on these things. But we don't give the okay. Why? Because the credit union CEO, that one human being, is solely responsible for who they get into bed with. It is their responsibility and no other. And I don't want to do anything that gives a false sense of security, right? We try to treat them like adults. You know your business, which also means try not going to interfere with it and try to do a DC knows best attitude. But on the other hand, we treat like adults. You got to be adults, right? You get in bed with your third parties, okay, and you do your due diligence. But it is interesting from a fee-based business, Kian. So when people talk about strictly buy, sell, hold, if we're talking about that in digital assets, as you know, there's a lot of pressure on other sources of income, political pressure, right or wrong, overdraft fees. CFPB talking about junk fees. They had a proposed max of $8 for a late fee on a credit card. You see the political pressure on interchange fees. The point is that if you're going to remove or reduce a fee source for a credit union and you want them to remain financially stable, well, it's like squeezing a pillow, right? It has to go somewhere. So new fee sources in general are good. So I'll say that, especially when it's one that isn't as volatile, So finding new fee sources is good. And if offering buy, sell, hold is one of them, that makes sense. There's also some neat possible stuff down the future. Maybe I'm getting ahead of myself, but a short-term small dollar loan against it, if there's a way to make it feasible, right? So instead of overdrafting by $50, but if you have $300 of Bitcoin, why not automatically create a $50 loan? You don't have to sell the Bitcoin. There's no taxable event. And in theory, it should be as secure as possible a loan because it's easier to grab the Bitcoin. It's a hell of a lot easier than foreclosing on a home or finding a car that is repoed. And it's actually even easier than grabbing a stock market because the stock market only trades 6.5 hours a day, 5 days a week. So there's some neat stuff in there. But man, do your due diligence. It's up to you. We do not endorse nor not endorse, although I am proud of some guidance we put out that is markedly different than that of the other agencies. But in general, fee businesses are good. And if this is a fee business you want to pursue, fire it up.
If I could just comment on what you just said, Kyle, I think the whole fee-based business thing is really interesting, especially around this time. I mean, I just put up a post on LinkedIn yesterday when Bitcoin hit an all-time high, and since then it's grown even higher, or not all-time high, sorry, 1-year high. And I think that's really a sign of us emerging out of the crypto winter. We see these ETFs now being approved, and with Bitcoin being able to be traded as an ETF, the volume for Bitcoin is going to continue to increase. And we're also coming up on the Bitcoin halving event, which is in April of 24, and the last Bitcoin halving event in April of 2020. The 4 months leading up to it, we saw about a 3x spike in trading volume. And so credit unions looking to take advantage of that fee-based revenue. It's a really good time to consider it, because if we're going to see the same thing we saw 4 years ago with the halving event plus the tailwind that we have coming from the ETFs, there should be sizable revenue to be captured. And if your credit union's not offering it, you're not only going to miss out on the fee-based revenue, but you're also going to be missing out on deposits, right? I mean, the members today, and we talk to a lot of credit unions that are studying the capital outflows that are going to these third-party exchanges, and the way at least our solution is designed is to keep the deposits in house, because the trades are actually happening directly to and from the member's deposit account. So, you'll take advantage of the fee-based revenue, but also maintain and grow deposits by being able to offer a crypto solution, which I think is an important point.
And if I can just add to that too, I mean, I think the risk of not having a solution, I mean, if your members are asking for a solution and they're going elsewhere for that solution, the risk is they go out to a Robinhood or a Coinbase or somewhere else. And we know that fintechs are building other sort of banking solutions. And so you risk potentially losing that full relationship that you may have with that member. And I think that's critically important. And I'm at Money 2020 this week, and I've been doing a lot of thinking about how credit unions and banks, traditional finance approaches things versus fintechs. And someone smarter than me said banks and credit unions tend to, 80% of what they do is protecting their existing business, and 20% is like investing in new technologies and looking towards the future. Well, fintechs are exactly the reverse, right? It's 20% protecting the old and 80% looking towards the future. And how do you compete with a fintech space that is a little bit less regulated, that is starting to offer other sort of banking type products And if you've got solutions going out to those because you're not offering your members something, I think that's a real problem. And further to that, humans are not really great about safeguarding their own assets. And, this is a new asset class. It is complicated for people. There is cryptography involved. And if you want to try to self-custody, that doesn't work out real well. I think about all the stories about where someone digs up a cache of gold coins that was buried generations ago. That's essentially what self-custody is. And unless you're smart enough to really manage that and provide even your own self-security, you could get yourself in a whole lot of hurt. So the opportunity for a CryptoFi or someone like that to provide custody services, provide trading services in a regulated environment with a trusted financial institution, a credit union, I think provides a whole lot of benefits.
And some people may not know, there's a sister agency to NCUA and FDIC called CIPC, and it is the insurer for your Fidelity and Vanguard accounts. Now, obviously, they don't insure you against losing money on the investments. But what they do is step in and make sure that if Fidelity went out of business, my IRA is still mine. The value of it is unaffected by Fidelity going bankrupt, and that I have access and an easy way to transfer it someplace else. And the entire time, my assets in the IRA should be performing as they would perform otherwise. But the only way, because CIPC isn't writing a check, because your assets are separate, right? Even if Fidelity goes out of business, my assets shouldn't be touched, right? That was the FTX thing. They grabbed customers' assets. Where I think that people in DC will be comfortable looking at it is if it looks kind of like that, meaning that if a crypto exchange goes out of business, the assets you already own are untouched and yours because they have a custodian whose sole job is to keep them. And I think something akin to that. And I can say politically, man, the last thing we need is a story that, hack at a small credit union. Remember, even though they could have bought the same assets on a separate exchange, they could have downloaded an app and done it, and they could have had a hack too. The reality is, if it comes as a result of the regulator and insurer's attitude, it's going to look bad. It's going to look bad for me, but it's going to look bad for everybody. So be very careful on that. It should look like when you hear that an exchange goes down, you shouldn't have one worry about your actual assets. You own 10 Bitcoin, you got 10 Bitcoin. It might take you a while to get them, put them someplace else, whatever, but you should never have a moment's worry that you have it. I think that's absolutely essential for this thing to work in one way.
Well, I think that's why it's important on the back end that there are, regulated trust entities holding these things. Because even if a trust fails, there is a legal process for getting those things back, protecting them from a bankruptcy standpoint, making sure that those members get their digital assets back. So yeah, I think you raise a great point, Kyle.
And I could comment on that too. I think the way we went to market with our solution was to give flexibility in terms of the custodial relationships to the credit union. So if there was issues with the custodian and they wanted to exit the market, like we saw with NYDIG recently, because CryptoFi is decoupled from the custody and we just own the technology, we can roll those members' digital assets over to a separate custodian. And so, that's something that we're pretty proud of, and we feel confident in keeping the industry's crypto safe, if that makes sense.
And I'm aware it's a new industry. I talked to people at Coinbase. Yep. I said, New York Stock Exchange doesn't hold anything for me. They're just an exchange. They match buyers and sellers, and that's it. And they said, well, when we started, Bitcoin exists. You remember the old ways people used to buy it, they're like, well, people said, oh, I want a nice, easy way, a nice app, a good interface to buy and sell. Well, at the time, there wasn't really this custody business. So I get it was like, well, we'll hold it for you, So I understand that. It's earlier in the life cycle. But at the end of the day, this is only going to work if those things are separate, meaning you don't have any concerns whatsoever, right? And again, the analogy would be my IRA and the assets in it should be 100% safe if I hear that Fidelity goes out of business, right? And it should be performing exactly as they should otherwise. I'll also say one more thing. Loans against digital assets, which in theory can be actually a very good interest rate. Now, if they're volatile like Bitcoin, you may have a low loan to value, but the interest rate on it, because of the ease of getting collateral, any collateralized loan, how cheap the money is depends a lot on can you get the collateral and what's it's worth. A home, the good news is you can find it, unlike a car. But foreclosure process is very difficult. You got the sheriff to show up, kick a family out. It's very painful to do. A car, you have to find. And securities, like I said, a loan versus securities are useful, but you can't grab them on Saturday night if you need the cash. If someone defaults on a loan against, say, Bitcoin, it's very important that if you're a credit union and you have a loan versus Bitcoin, you know that you have access to the collateral. That's the only reason you're giving good interest rate on it, that you can get it at 2 a.m. and it should be like a smart contract. It does it automatically. And I ask credit union people out there, please, for the love of God, test this thing first. Don't have a $5 million problem, have a $5 problem. We got a guy who's got an 8-figure loan, credit union, versus Bitcoin. And now it was made back when Bitcoin was $40,000. And last time I talked to him, Bitcoin was down like 26 at the time. So it's had to been topped up, margin calls, and that worked. And I said, okay, but if they default, are you sure you can grab the Bitcoin? He's like, well, we have legal rights. I said, do me a favor, create a $5 loan, make it default and grab it so you know you actually have it, and then instantly sell it because you're not supposed to have Bitcoin on your balance sheet. Grab all of it or some of it. Make sure that process works, because the time to find out that it's clunky or you don't really know how to actually grab the Bitcoin, liquidate it, and pay off your loan, the time to do that is before you get into these situations where somebody defaults on a $50 million loan. So just experiment, do test trades,
I think one just important thing to note on that, I think that is a really good use case. We haven't dove into lending yet, but it's something that is a little more distant on our own roadmap. And I think one important thing to note is, like Larry was mentioning earlier around self-custody, it's going to be really difficult to do lending against Bitcoin if you're allowing your member to self-custody that, right? Because like Kyle's saying, you're not going to be able to have a mechanism to be able to recoup that asset if you need to. And so by leveraging a third-party custodian, it's much, I think, more streamlined to develop a solution that contemplates, what happens if a margin call isn't made and that asset needs to be liquidated, and
a mechanism to instantly liquidate, right? Because you can
you
can have real estate owned when you foreclose a house. Credit unions wind up owning automobiles they don't want when they repo them.
Yep.
But you're not supposed to be owning Bitcoin. So you should own cash, because grab the Bitcoin or whatever the asset is, instantly liquidate all in one process, and you have cash on your balance sheet. But yeah, it's some of the notions are out there, and it kind of helps politically on the small dollar loan. If you can, because no institution wants to make a $75 loan, right? To have a loan number and a file and all that. But if it could be done to combat overdraft and that sort of thing, if it's you got to pay rent today and you're $30 short, there are no good options, right? You can bounce your rent check or your mortgage and hit your credit. You can pay an overdraft fee. You can go to a payday loan place. None of the options are good. It would be a lot better, a $30 loan against Bitcoin, which you can't default on ever. There's no trap, because it's a margin loan. I have a margin loan in my brokerage account. There's some neat options here that can even help us when we talk about people who are in a bad way. All the focus on junk fees. Well, what if you just either instantly, or you got a notification you're going to overdraft today, you got $500 in Bitcoin, you need 30. Do you want to borrow some of that, at a good rate? And then, and again, you can't default on it, because if Bitcoin price goes down, they just sell it and pay it off. So there are some really neat possibilities, I'll say.
Kyle, it's probably worth reminding people, even after this crypto winter, there's still 20% of Americans that are holding cryptocurrency. So those assets are out there.
I was at a conference last week, and somebody said, all right, and it was on this topic. And they said, you got one sentence you can give one thing you can say to President Biden, for policy on this. And I would say, I think there's more votes to be had not being abusive to this industry than there are being abusive. I know there are votes and donations to be had being abusive. I know that. I'm not naive. But I would not want to sit there as a president or governor, whatever, losing by 0.1% in a super tight race like we often have in this country, and wondering, wait a second, Maybe if hashtag XRP Army and hashtag, they're going, could have used 10,000 more votes in Pennsylvania, anyway, that's what I would say, is that there are more votes to be had. You don't have to be pro Bitcoin. You don't have to be anti. You have to be pro American innovation and Americans doing what they do best. The same as we did with the last disruptive technology called the internet, which had lots of downsides. Every new technology that's widespread has negatives. It's always 2 steps forward, 1 step back. I've said it before, we had 0 plane crashes before we had planes. Thousands of years, literally not one. And the internet, you never had a computer virus before you had computers. And there's awful things that happen with the internet. And it caused massive economic disruption. We lost all of our video rental jobs and travel agents and all that. But we got the most upside. Canadians and Mexicans also lost their video rental jobs. But the only thing they get is the consumer use. They get to watch Netflix Canada, right? And that's cool. But they don't work at Netflix headquarters. They don't work at Hulu headquarters. They weren't the employees that got in early and got stock options and changed their life. They're not the investors. And you know how local investing is, even if venture capital firms. They got in there early, the endowment funds, they got the return. If it's something's disruptive, the worst thing that can happen is all the negative, because you're going to get that anyway, eventually. And none of the positive. Anyway, that's sort of my overall shtick.
I actually hate to jump in and ask another question, because this has been really
Please
good.
do. We don't have that
really
much
good.
longer. If you want to let some of your viewers or listeners or whatever jump in if they want to, but yeah.
Yeah, I'll go back and check the questions. But while I do that, you all have talked about self-custody. We haven't really defined what that means. So for those on the call here, what do you mean by self-custody? How does that differ than if a credit union, say, were to custody something, or a trust company?
That's to you guys, right?
Yeah, I'm happy to start. Is self-custody is when you control your keys. There's this saying in the digital asset space, not your keys, not your crypto. There's a public key and a private key, and we don't need to go into the details around that. But imagine a very complicated password. If you lose that password, you misplace that password, someone breaks into your house and forces you to give them that password, you've lost access to those digital assets forever. And that's a high bar to set for most people. I lose things all the time. I misplace my keys. I can't imagine misplacing crypto keys. So there's a real risk in doing that. Especially as we age, we forget how to enter some of those complicated keys into whatever devices. There are hot and cold devices. I mean, you have to be pretty technologically savvy to really do this. And there's a younger population that is comfortable with that. But as we know, digital assets isn't strictly a younger clientele. It cuts across all ages. It's those that are technologically astute. And so we need to be able to provide solutions for custody that don't require memorizing large seed phrase or writing it down on a piece of paper or storing it in a safe deposit box. It's just too cumbersome. So that's what custody does for you as opposed to self-custody.
Yeah, and if I could just comment on that too, I think data point I saw recently is 30% of all Bitcoin has been lost because of people losing their own seed phrases. And, when we think about the banking system and how it came to be, however many years ago, it was because people didn't want to have to continue to store cash and underneath their mattress or dig a hole in their backyard, right? And so if you're trusting your credit union with your cash, why would you not trust your credit union with your digital cash as well? And so that's the analogy that I like to make. And one other ancillary point to that is around gas fees. So a gas fee essentially is when you send crypto. So if I'm sending Bitcoin to Kyle, then there's going to be a very small fee that's paid to the folks that essentially, for lack of a better term, operate the blockchain. And that fee sometimes, when there's a lot of congestion on, especially the Bitcoin blockchain, can rise up to $15, even $20. And if you think about the average transaction size of a credit union, it's in the low hundreds of dollars, even less than $100. So if I'm buying $100 worth of Bitcoin, and then I want that Bitcoin to be sent to me so I could self-custody it, and I'm paying a $15 fee for that, that's a 15% fee that I'm essentially paying just to buy that Bitcoin, not including the fee that I paid to buy it. And so self-custody in at least my opinion, really isn't viable for folks that are doing smaller dollar transactions, notwithstanding the point as well around the security aspect of it. So you're on mute, Kyle. Yeah.
Yeah, what I was, by the way, on that, I would say, I even bought a T-shirt that says "You're on mute." You know, it's the #1 expression from the last 3.5 years. I would say, never feel too bad about accidentally being mute, because that's bad. But you know what's a lot more dangerous? Thinking you are on mute and not being. That causes way more problems. Anyway, I would say for credit unions themselves, just to be clear, the Federal Credit Union Act, for a federal charter, it's about 2/3 of them of America. They have very limited trust capabilities from Congress. As I understand it, I don't know how easy it would be for the credit union itself to be the custodian for federal charters. I think the experimentation, to the extent credit unions want to do that, will be at the state level, and that's up to your state regulator. There's nothing that prohibits that from a state charter from NCUA's perspective from doing it. But like, I think credit unions can have IRAs, but they don't have a ton of trust ability for federal charters. But God bless the dual chartering system. Wanted to mention that, but I want to ask you guys as we wrap up here, if NCUA doesn't, we've put out general positive guidance, blockchain technology and digital assets, purposely sort of broad. And this is not how I want the world to be, but it's very different than the way the other American regulators have put out, right? The way that the other regulators have put out is putting a kibosh, even though I'm not sure that it was meant to, on stuff that isn't even really buying and selling, just using tokens, tokenized deposits, blockchain-based identification, right? Putting title for real estate on a blockchain, you know, you're not really investing in crypto the way people think of it. But anyway, just say be careful out there. And if there's guidance that is needed, right? My only role in any of this is if somebody is saying, I'd love to do that, but you know, my regulator, the government, you know, that's my only role. Now, sometimes that's a way to get the salesperson off the phone. We get it, but that's my only role in this. If you guys have any thoughts on guidance, or your viewers do, I don't know if anything's needed, but what would it look like?
I might just jump in there. You know, we've talked about stablecoins in the past. There's also tokenized deposits. There are some subtle but important nuances between the two of those. But you know, I've been talking to a lot of large financial institutions lately, TD, Citi, and a number of them have participated in a trial with the Fed, Swift Network, MasterCard, and about 7 or 8 banks and something called the Regulated Liability Network. Citi's doing something similar with the Tokenized Collateral Network. Yeah. They are starting to tokenize all sorts of assets and play with this stuff, understanding that regulation is going to come eventually from Congress. And when that comes, they can kind of turn on that switch. I would encourage credit unions to get up to speed and start thinking about both of those solutions. You know, stable coins offer a whole lot of opportunities, as do tokenized deposits. And again, they're very different, but there's also going to need at some point to be a tie-in with these larger networks that the big banks are playing, because while they trialed it, my understanding is they're going to move forward with it. I talked to a UK person in the UK who was very close to what the UK government's doing. They said, oh yeah, that regulated liability network, we're working on it. That's going to be our baseline. And so this stuff is coming. And so it's important for a credit union to at least get familiar with the concept of digital assets and the concept of things trading of value on blockchains or a unified ledger, whether it be centralized or decentralized. But I think in the future, some guidance around, and I think the guidance, my preference would be there should be no hurdles to, you know, investigating or trialing either a stable coin, could be a credit union stable coin, or a tokenized deposits. Differences being there that stable coins are fully collateralized, probably couldn't be rehypothecated. Tokenized deposits would be a deposit token that would,
the good stable coins are.
Yeah, they would operate just like anything else, but like any regular deposit. But both of them have real interesting implications for the future of payments.
100%. Yeah, and I also say, in terms of what advice is, you need to know the people you're doing business with, their business model, their financial stability, investors, what have you. But in terms of the technology, people say, I don't really understand it. I said, fair enough. I've been using the internet for decades. I have no idea how it works, right? We're doing this video conference now. Like I can't live without my smartphone. I have no idea. It beams to a satellite or something. I have no idea, right? I know when I hit send on an email, it goes to somebody. So we use things all the time that we don't actually totally understand. What you do need to know is what your partners are, who they are, and what the business model is and how stable it is. I wouldn't wait to not do something because you don't fully understand the tech, because I don't know how many people on this call right now even understand how this is even possible, this video conference, right? I don't.
Kyle, that's a great point, because and it's something that we saw came out on the banking side from a guidance standpoint, was around third-party relationships and the risk that's involved, because a lot of these new fintech solutions, we're familiar with the FISs and the Fiservs of the world, the MasterCards and the Visa, right? There's not a lot of risk in partnering with them because they've been around for a long time. We know their financials. We know what third-party providers they use. A lot of these new fintech solutions, we don't know that. So it's really important to look at the leadership, their background, what other projects they've been involved in, to look at all the third-party relationships that a provider may be using. If they've got a custody partner, who is that custody partner? What is their history? So there's just a different level of due diligence that you need to do on any new tech provider, whether that's digital assets,
Yes.
that's artificial intelligence. And I would just encourage people to take a much deeper dive. And if you don't have a procurement department that's comfortable doing that, reach out to a third party, SRM, some other one, to help you with that process, because that's going to be really important to make sure that we don't make a mistake that's going to impact the industry.
And appropriate insurance too. Like if a credit union was going to do custody, you should have insurance on that. Obviously, NCUA does not insure that, but credit unions have lots of insurance. We don't insure their property and casualty, right? NCUA only insures deposits, nothing else. So they have lots of insurance policies that have nothing to do with NCUA, and you may want to have one on to protect your custody business if you're doing it yourself. But we'll see what happens from NCUA's perspective. I did see OCC is having some seminar next month on tokenized deposits, right? What I was getting at before there was the guidance they put out a while back, where it said you have to get written notice of non-disapproval from your examiner. It said digital related to digital assets, digital space assets, without any further clarity, and knowing that nobody wants to start a project and then wind up that you get, your examiner doesn't like it. Well, a real estate type could be, without any further clarification, maybe that's considered a digital asset, and that sort of thing. So, payments, remittances that briefly use some sort of digital asset, where nobody's investing in anything, without any further clarification, especially the smaller entities. That would be an incentive to not pursue a new project if you we're just left with a broad interpretation of what digital asset was. It's good to see, I think the OCC talking about tokenized deposits. Again, nobody's investing in anything. It's just another way to move the things that we already did.
Yep. I am getting the general feeling, and I'd be curious on your opinion on this in Washington, but at least some of the regulators and the folks at the OCC and the Fed, I think there's a general feeling that they might have gone a little too far or a little too heavily handed on kind of cracking down on some of the digital stuff, because now there is a recognition that this is a geopolitical issue in keeping America competitive and innovative. And I think they realize that we may have stifled that innovation a bit. So I think we'll start to see them open it up a little bit on the banking side, which is important for credit unions to understand, right? I think credit unions have a really unique kind of short timeline to get up to speed on this stuff and leverage it to your advantage before the banks start rolling these things out themselves.
I would say when you speak to your examiner and supervisor, if you're a credit union, one interesting note, none of us in the federal government, in the executive branch of the agencies, we're not allowed to own $1 of digital assets, right? Nobody at the SEC does. Well, you could be like a mailman and own it, but you can't have anything to do with policy and own $1. That's an issue. When it seems like the longtime employees at Treasury or SEC don't really understand it, it's probably because they don't, because they've never bought or sold anything. By the way, also applies to your spouse and children. But that these things, like Larry, like you said, even put aside crypto, people buying and selling, just flat out useful. There's a difference in a .com boom between buying an internet stock and using the internet for your business, using email, having a website, having bill pay, and just the flat out uses. So when you speak to your examiner, my point is, if you've got a blockchain-based identification to speed onboarding, to reduce fraud, you don't need to geek out, even if you understand it. On the tokens, and the people talk about hash rates and gas fees, whatever. You know what they do understand? They do understand less fraud.
Yeah.
And as an insurer, we like that. 4 out of 7 credit unions last year.
Instant settlement, eliminating counterparty risk, eliminating settlement risk, 24/7
They understand
operation.
that.
Those are the things that, improve their cost.
Good for the examiner.
Yep.
Those are all good things. Maybe even opening up a new fee-based business like remittances, which you didn't do because the KYC AML was such a pain. Yes, instant settlements, cheaper payments, less fraud, faster onboarding, easier to get new members. They understand all those words. Cut to the chase, cut to the chase. The industry is getting better. But when I worked on Capitol Hill, and Coin Center would come in, and these guys would nerd out. They'd have all these people just like, what? And I say, it's good that somebody knows it, but if you had to go back to your younger self from 20 years ago and describe a smartphone, you wouldn't talk about 5G technology and wavelengths and satellites. You'd say, when I need a ride, I hit a button and a guy in a Hyundai comes and picks me up. You say, I don't get lost anymore. I have a real-time map. I can do video calls walking down. You talk about the uses, the concrete everyday uses. And anyway, I always try to preach that.
It's important to separate the technology from the coins too, right? Because people get so hung up on the name cryptocurrency. And yeah, that stuff's important because you do have members that are trading that, and that may or may not last forever, but that underlying technology, the blockchain, digital ID, those are things that are going to last forever and going to impact banking as we know it. That said, for those credit unions that have been a little reluctant because the market has been funky, this is and again, this is not financial advice, but this market is a very much a up and down market. And, there are some real tailwinds for Bitcoin. And I'm saying this because you're going to start to see your members asking about it again. Bitcoin and other digital assets are trading up pretty significantly. I think Bitcoin's up 12% today. The halving, as Kian mentioned, will happen in 2024. That's going to increase the price likely. The SEC recently was rebuked in court on rejecting Grayscale's application. They're not going to appeal that decision. So it looks like we will get an ETF. That's going to cause a lot of demand. And right now, Bitcoin appears to be trading more like a safe haven than even our own U.S. Treasury bonds in a risk-on environment, which is really interesting. So I say that being that your members are going to start to have interest in this again and are going to start to ask for it. And wouldn't you much rather provide them with a safe, regulated way to hold those digital assets as opposed to go into another company that might end up being an FTX?
And on that point too, oh, go ahead, Kyle. Yeah.
I was going to say, your members might not even actually be physically asking you, but when you see the ACH transfers out, that's them asking you.
That's exactly right. And, just back to what you were saying earlier too, around the stablecoins and the lending. I mean, a buy, sell, hold solution and getting engaged with a third-party qualified custodian that can custody digital assets can do more than custody in just crypto, right? I mean, they could custody different sorts of like a title that actually sits on the blockchain for a car or going down the path of lending. All these things really are rooted in a strong qualified custody solution. And one of the interesting things too, somewhat recently in the market is PayPal stablecoin. I think we're going to see the emergence of a lot. And Kyle, you mentioned earlier, not all stable coins are created the same, which is absolutely true. We see coins like Tether that is, backed by corporate bonds and other things that are, a lot more risky and could cause issues for that whole stablecoin ecosystem. But for everything I've read, PayPal stablecoin is being done so in a way that is backed, dollar for dollar, and
you need liquidity. And you need a loan mechanism because digital assets trade 24/7.
Yep.
Even treasury bills, super safe. They don't trade 24/7. If you did it 2 Fridays ago and you have Columbus Day was the Monday, you may have the money. But to get the cash, they trade on a different schedule. They trade on the old school financial market schedule. So it's one thing to have $100 for every 100 issued. You also need to have some sort of short-term facility to pay out, because might not be able to sell your bonds for a few days.
Yep, no, that's absolutely right. And if you're allowing these sorts of stable coins to be a part of your credit union ecosystem, that could be another interesting way to grow your deposits too. Because if your members are holding the stable coin, say in PayPal or some other third-party platform, you could allow them to deposit those stable coins right into your credit union, which will obviously in turn then increase your deposits once they sell that stable coin and it converts back to fiat currency.
And that, Kyle, Kian, I talked with Paxos yesterday, had a really good conversation with them about their partnership with PayPal. So for anyone who doesn't know, Paxos is the underlying issuer for PayPal stablecoin PYUSD. They are regulated under the New York Department of Financial Services. They are highly regulated. They're doing a lot of the right things, but they are looking at a longer term strategy with this PayPal stablecoin. PayPal stablecoin can be used for payments at PayPal's 40 to 50 million merchants. It can be used to transfer between different platforms, including Venmo and PayPal. In fact, I've tested both of those. Ultimately, other platforms is now trading on probably at least half a dozen exchanges, which means that people outside of the US can hold PayPal stablecoin as a way of holding US dollars in a digital format in regimes that may not have a good monetary system. We are going to see that start to creep into regular payments. I also talked with Circle yesterday. They've got a lot of strategy around these things creeping into everyday payments. We're seeing more A to A or account to account payments in this world. And I say this because credit union, a big value to credit unions is interchange, right, as a revenue source. I sat in on a presentation called The Death of Interchange yesterday. Interchange is going to go away. A lot of it's going to be a death by 1,000 paper cuts. But as a credit union, you need to start thinking about leveraging these new technologies as an additional revenue source, as a new revenue source, because all this is technology is changing. We're just getting different sorts of technology, different sorts of payment mechanisms, different sorts of rails. And if you hold on to that old technology, that 80% holding on to the old and investing 20% in the new, you may find one day that your members are using totally different rails for payments, and you're not getting the interchange you used to. And if you haven't built a replacement for that revenue, you're going to be in a heap of hurt.
If I can jump in here with a question, we have a really good one that came through. And this is directed towards Kyle, but I think everybody here can jump in. Is there a way to understand what NCUA examiners will be looking for when a credit union adopts a buy, sell, hold solution? And then obviously, while the credit union is following guidance, will there be additional or updates to that guidance? And is there like a top 3 items that credit union should be aware of from an examiner side?
If you're following the guidance, and let me be clear, the reason we put out broad guidance on this general topic, we put out 2 pieces, third-party relationships on this, and then also just, hey, there's a thing called blockchain. It's interesting. That was more of a signaling mechanism, right? It was also a signaling mechanism to the venture capital world, to Silicon Valley, that, hey, there's this market called credit unions, kind of forgotten about. That was another reason for the guidance. But the reason it was guidance and not a rulemaking, why? Because it didn't break any rules. Partnering up with a crypto exchange or BuySellHold didn't break any rules, but guidance can be useful as a signaling mechanism. The main thing is what I said at the very beginning: who you partner with, it's your responsibility and no one else's. Speak to the examiner. I would mention if other credit unions that they may examine are doing this and there hasn't been a blow up there, and the benefits to you, talk from the examiner. What do they want, right? Because we're an insurer, not just a regulator. We like stable entities, like every other insurer in the world. We like getting premiums and don't like writing checks. So what you're saying to the examiner is, this is not going to blow up your career. This is not going to create a big check. As a matter of fact, it's going to go the other way. New fee business is helping out all of our metrics. Maybe not a huge amount, but it's helping them. And even if temporarily in the short run, there is a cash outflow to get something started before it starts paying dividends, you explain why. Because if it's true that it actually helps your finances, that's what the examiner cares about at the end of the day. Because if there's a blow up at a credit union, the first question is, wait, who's their examiner? Who's the supervisor? And it's not good for their career. They're people just like us, they want to get promoted. They want to have a good career. And so you frame it in the very truthful ways in which it will benefit the credit union's finances and not harm the career of the examiner. And
I think
by
that's,
the way, yeah.
I think that's very, very important takeaways. And as a former examiner, I'll give my perspective on this too. Do your normal due diligence, and Larry, I'll toss this over to you in a second about what a credit union should be looking at when they're partnering with a CryptoFi or with another solution, and what should they be looking at from a custodian standpoint. But do your normal due diligence, obviously enhance it and understand where things are going. And so in a CryptoFi solution, it's not just CryptoFi you're looking at, it's also the custodian. You have to also understand the flow of funds. So the funds aren't stopping at CryptoFi, so you have to know all of your parties that you're associated with. And if you can explain how all of that works to your examiner, and if you have a policy in place, you have procedures in place, you're going to check a lot of the initial boxes that they're going to be looking for. Larry, I'll toss that over to you. From a due diligence standpoint, what are some main things that pop up?
Yeah, so you're going to want to make sure that the partner has all of the kind of standards and procedures and policies that you would typically have. We when we do these things, we typically ask a pretty wide set of RFP questions covering support, governance, compliance, security, functionality, liquidity, exchange, custody, client experience, insurance, integration, and pricing. We also ask for full due diligence packages. To my point earlier, this isn't necessarily just digital asset providers, but any new technology provider. You should be looking at what their BSA AML policy is. Do they even understand what BSA AML is? Cybersecurity, info security, privacy, identity, or incident response, business continuity. When was the last time they did their penetration testing? Business conduct and ethics, third-party provider risk. That's a big one. Something like a pandemic plan. We just got through one of those. SOC 2, SOC 1, SOC 2 audit results, risk assessments, financial statements. And then depending on the complexity and how these things are set up, there may be licenses required at the state level or federal level. It's really, and then at the end of the day, you need to have a conduit or a way of providing this information to your regulators. I think this is one of those areas, if not always, it's a good time to kind of talk with your regulators. This should be a partnership with your regulators. There should not be any surprises. This is a learning opportunity for your regulators. It's an opportunity for you to get feedback. You don't want any last minute surprises when you go to launch something and you've got an unanswered question. If you hold hands with your regulators and go through this and talk about, to Kyle's point, all the right reasons why you're doing this. This isn't about cryptocurrency. This is about driving revenue for the credit union. This is about providing a service for your members. This is about improving their liquidity situation. It's about planning for the future. It's about understanding the technology. It's about building out blockchain and other sorts of ancillary services that are going to be related to the digitization of money. Those are the things that we think about.
Yeah, I would have something graphically to show, like you mentioned, cash flows. Well, here's how the world was, which is the money leaves and that's the end of it. And it goes to Coinbase or what have you. And here's the new world that we're doing, which is it leaves still, but we get some fee out of it. And it's actually a service we offer because the friction is less to go back and forth. And I'd have like a one-pager, that says this is what happens. Also shows that you've thought about these and want to understand it, I would not want to just verbally say, oh, it goes like this, whatever. That would make me nervous. I'd want to say, oh, okay, see something like here's Susie credit union number. Yeah, here's a credit union account, something easy to understand.
And list out those benefits of what, maintaining that member relationship and these other third-party solutions that they may be sending money out to the Coinbases of the world, like, maybe outline some of what their product plans are, and how many of those look like traditional banking products, and to help the regulator realize that this is a very competitive environment, and if we want to maintain our memberships and serve our members the way that we do and serve our communities the way that we do, we need to make sure that we're offering the right products and services and not losing to a fintech.
And on that point, I think one interesting data point to drop here is, Robinhood, who's historically thought of as a third-party trading platform, has quietly grown into a bank. They did $234 million in interest revenue in Q2 of this year. So 1 quarter alone. So tracking towards $1 billion of annual revenue from interest income, which is obviously stealing members and capital and deposits from credit unions. And having your own in-house trading solution will help keep those deposits in-house as well. So
perfect. So we have 5.5, 6 minutes left here, and this will be open for everyone. So besides this current buy, sell, hold solution for cryptocurrency, what other use cases are you excited about? Do you think we'll see in the near future, long-term future, that could enter the credit union space or just the world in general?
Well, I'll guess I'll lead. I already had a couple of them. I think tokenized assets and Stablecoins. Digital ID is in there as well to kind of comply with some of the travel rules and making sure that you know kind of who your counterparties are. Obviously, artificial intelligence is going to play a role as an emerging technology. I mean, those are a couple off the top of my head. I'm sure Kyle and others have a lot more.
Yeah, the professor from Chicago that talks about this stuff a lot. He made the analogy, the credit union group, and said, listen, this may sound complicated, but it's not in terms of tokenized assets, right? We already deal with financial instruments very differently than we did 50 years ago. The reason a bond coupon is called a coupon is because you have to physically cut it out of your bond, mail it in, and then get a paper check. We don't do any of that anymore, right? So it's just going to change again. But if you've ever been to the state fair or Chuck E. Cheese, where you buy a bunch of tickets, when you get in, this ride's 2 tickets, this one's 1. It's the same thing. You exchange cash for tokens, these tickets. And the reason you do it is because it's easier. It's easier to just say, here's the ticket than to have each person counting the bills, getting change, whatever, right? It's a smoother interaction. The same thing is when you have tokenized assets, tokenized deposits, bonds, et cetera. It's smoother. But I also want to say this. I want to be very humble about this because we're still relatively early in this. And I know when, the internet came out, it was web pages. You were either on the internet or you weren't. And it was a series of web pages, and they did stuff and they said stuff. Now, like I have an app on my phone's GPS. Am I on the internet? Did I go online, as they used to say? No, even the words change. And like it's not a web page anymore when I'm using my GPS. I didn't go to a URL. So my only point is, I think there's going to be applications that are steps beyond at least what I can guess right now. The same way, the way I thought of the internet was a series of URLs, a series of web pages, and now it means a whole bunch of different things. But anything that helps the core of a credit union is good. Anything that lowers costs is good. Reduce manual labor. Fraud creates a ton of attention away from other things. Less fraud is good. Higher revenue is good, such as a fee-based business, buy, sell, hold. And the ease of starting up. We can also see credit union members vote on their board of directors. You could do that with tokens. There's a way to do that. You just, send a token and that's your vote. So that's kind of a neat straight up application, but it'll be interesting to see what happens.
Kian, I'll turn over to you, but I just want to say, I don't know if the camera's gonna pick this up. I do have my Chuck E. Cheese debit card here, Kyle, as well. So they're innovating too. They're going from the tokens to the reloadable.
Steal those deposits.
Chuck E. Cheese, that is such a racket. They're going to feed you. Is it going to be pleasant atmosphere? No. Is the food good? No. It's going to be the worst pizza you ever had in your life, and you're still going to pay. It's just a racket.
I love it. I mean, I think we talked about it already, but what I think I'm most excited for beyond the buy-sell solution is stablecoins. I think it will fundamentally disrupt the way that money moves and people transact long term, and will disrupt a lot of that interchange revenue. So it's going to be exciting to see how that space emerges.
Kyle, I keep calling you Kyle. I don't know why. I think I watched South Park last night. Kian, if I can add, I'm at the 2020 conference, and it's funny. I was thinking, man, maybe I'll see one or two digital asset providers, right? It's probably every quarter of the booths are digital asset providers. I posted on LinkedIn yesterday a picture of the booth. I mean, they're the strong ones that have survived, right? The Ripples, of Firebloxes, the Circles, the Paxos. But it's still encouraging to see that this isn't going away. And I would encourage everyone on this call, we get our news often through the media, right? And media tends to paint everything in a negative brush. If it bleeds, it leads. And like the Sam Bankman-Fried story and the Terra Luna collapse, like, oh, you would think that this is the worst technology in the world. And even like the Senate banking committees, they'll trot people out pro and negative, and the negative ones are just saying this is all it's all a crock and these people are all criminals. Like, I would encourage people to look behind those stories, and in reality there are a lot of fintechs and a lot of banks and a lot of central banks and institutions that are building around this stuff, because it's just a technology. It's not scary, but it is going to impact finance in ways that are going to be hard to understand. So it's not all big fraud and not all big scheme. And this stuff is not going away.
Perfect. We are exactly at time there. So thank you, everybody. If you want to connect with any of the panelists, they are all active on LinkedIn, so feel free to reach out to them there. The recording will be distributed. And thank you again, Kian, Vice Chairman Hauptman, and Larry as well. Larry, enjoy the rest of Money 2020. And everybody else, have a great rest of the week. Thank you.
Thank you, everyone.
Thank you, folks.
Thanks, everybody.